Hi everyone. So in this video, we're going to talk about long-term investing for 2020. How does that change? What should be your strategy? What should be your narrative? And what should be the conditions that long-term investing should be for? And here's the thing, no, before I start, I realized that I've been making a lot of trading videos. I've been making a lot of stocks by request videos, but there's looking at stats know that there's more investors actually in the Philippine stock market than traders. There's more people who are more passive in their investments than traders per se. And I tried to validate it also. I tried to make a poll in Instagram. And just to show, no, this was April 30, just a few days ago. 79% of the people who responded were basically investors than traders. So before I also begin, I want to start, put it in the comment section if you are a trader or if you are an investor or if you're doing both, just comment both. But at least I want to have a sense, no, there's over 105,000 people who subscribe to this channel, and knowing which of you guys are traders and investors would be so interesting also. But here's also the thing: long-term investing is something that works. It's something that's legit. A lot of the people that have a lot of money, that know how to weather storms like this, are also investors. But I want to also comment on this, that please remember that aside from long-term investing, that it works. It's a strategy. It's something that you do intentionally. Stop talking about na you're a trader, that kung naipit ka, you lost money, then you became an investor. You are an investor because it's part of your plan. You are an investor because it's something that you wanted to do to begin with. You are an investor because the parameters for you buying a stock, holding a stock, avoiding a stock, and ultimately selling it are based on investment principles, are based on investment strategies, are based on items in your checklist that would cause you to buy it as an investment and would cause you to sell it as an investment. It does not if you are a trader and then the stock starts to fall, please do not be an investor. That's the worst thing that you could ever be. If you're a trader and the stock does not go based on the trade that you want it to be, you need to sell, you need to cut loss, you need to get out of that position, you need to stay away. That's why it's so important to follow your plan. If you are a trader, when technical analysis parameters to sell have been out, you need to sell and you need to get away from that position. If you're an investor naman, if the stock is falling, we're going to address that later, what are you supposed to do. But again, the premise for trading and the premise for investing are totally different. So if you are a trader, you could go on to our stocks by request videos. We have a lot of that in this channel, but this videos particularly for long-term investors. And if you are a person that wants to know more about technical analysis, there won't be any technical analysis here. But if you are a long-term investor and you want to double down on that skill, you want to get better in it, or if you're new and you don't know the context of what long-term investing is, then this video is for you. So before I start, people have been commenting also, please introduce yourself to every video because there might be people who may not know you. So my name is Marvin Germon. I'm a stock market trader and investor. I've been investing in the market for more than a decade now, and I just like sharing my thoughts over YouTube, that hopefully it gives you the right insight, it gives you the right information to trade the markets with confidence. We have over 104,000 subscribers in this first channel, which for those who are watching this channel, this is primarily focused on the stock market. So if you're new to this, super appreciate it if you could subscribe and you can smash that bell so you get updated every time I come up with new content about investing and about the stock market. And I opened another channel, it's called Marvin Germo Podcast. That's where all of my non-stock market content will be. That's where all of the entrepreneurship videos, the CEO interviews, the business videos, the insurance videos, the real estate videos, everything that's not the stock market, but everything that you guys like in terms of saving, personal finance, budgeting as well, it will all be there. So the link to that channel is in the description. It's called Marvin Germo Podcast, and super appreciate it if you can support that. Also, I just opened that during the lockdown or a few days before the lockdown. It just has 2,000 subscribers right now, so appreciate it if you could show that channel some love as well. Now, I want to answer, at least by the end of this video, no, you should answer a couple of things. Number one, does long-term investing work? Is it something that's worth your time, your effort, and your money? And is it still applicable also for 2020? hopefully after this 20-25 minute video, you get a better conviction about long-term investing. You get a greater insight on what it truly is so that you can make the right decisions on your investments. And please remember this, watching a video doesn't make you an expert. Watching a video doesn't also mean that you won't make mistakes in the market. Mistakes in the market are normal. Mistakes in the market happen, but you use those mistakes to help you get better. You use those mistakes to help you develop the experience, to help you develop that acumen, because it's that experience plus skill plus acumen done repeatedly over a stretched period of time that's what's going to help you make money. So there, just a quick plug. We're gonna have this. It's called Breakthrough Through the Crisis. It's entrepreneurship, investing, finances with Sean C. It's my first time now. For those who are asking about online courses that are live via Zoom, this is one of them. So if this is okay, I might transition and do more of this. So if you'd like to learn more from Sean C and myself, just go to the description below. Look for the event where it's a live Zoom meeting. Click that, and it will lead you uh, to the registration page. So, anyways, before I set the premise about long-term investing, I want you guys to get this. The conditions for you doing long-term investing is are the following. Number one, your time horizon must be at least 10 years. So why am I saying this? If your time horizon is not 10 years, meaning you need the money already in less than 10 years, it doesn't mean you can't invest in the stock market, but it places a greater amount of risk in terms of how you invest your money. It places a greater amount of there might be, if you make mistakes, your ability to catch up, to bawi from those mistakes will be harder. Your learning curve also, because you have to understand this, you can't really expect to be profitable in the first few days, in the first few weeks. When I say profitable, of course you will make winning trades, of course you will see stocks go up, but it's not something based on strategy. That was based on probably just bought it, you just had money at the right time when it was also down. But to build consistently the conviction and the strategy, it's something that you would build over time. And the same way with your job, no, you can't expect to be good at your job on the first week of you working as an employee. The time that you became better was when you developed the skill over a period of time. And it's the same way in the stock market. For you to be good at it, it requires time. So having at least a 10-year horizon gives you enough time that on the first few years, if it's not doing so well, you get to build that skill and you get to build that acumen. So if your timeline is shorter, I may suggest that trading might be good. If your timeline is shorter, I may suggest that preferred shares may be good. If your timeline is shorter, I may suggest that you buy stocks that are giving you high dividends, that are not as volatile, that don't have a high beta. So at least when there's volatility, your asset is somehow, though, it won't drop as much, and you still get your cash flow. But for those who are into growth, for those who are into capital appreciation, for those who want to crush inflation, for those that want to get something that has a greater return but a greater amount of risk attached to it, my suggestion is 10 years. And here's the thing. It's not exactly 10 years, no, but close to 10 years, there's something that would bring markets down. As you all know, 2000, in looking at it from the US markets, 2001 there was a dot-com crash, dot-com bubble. Then 2008 there was a global financial crisis. Then fast forward 12 years later, 2020, we have this caused by the coronavirus. Looking at it from Asia and the Philippines, 1997, you had the Asian financial crisis. 2008 you had the global financial crisis. Then 2020 you have the coronavirus. So somewhere, no, at a certain period, no one can pinpoint when a recession will happen. But what's so interesting about that, it's not about if it will happen, it's only a question of when. So since no one can predict when a recession will happen, when a market crash will happen, having at least a 10-year time horizon, even if you enter at a very very bad time, will give you enough time to somehow also position when it's down, and to somehow recoup the time where you made the mistake also. So again, if you are investing for more than 10 years, then this video is for you. If your timeline is shorter, then it may not be for you. But looking at my analytics now, I know that people who are watching this channel are 25 to 45 years old. So if you're gearing towards putting in your money that you can take out at 60 years old, everyone almost fits the bill. So Comment below if you're in that range. If you're below 25, that means it's nice you're younger, you can be more aggressive. If you're above 45, you can still invest in the market, but you have to be more precise. You have to be more calculative in the way you do it. You cannot have more mistakes because you're relatively older already. Now, another thing that I'd like to mention in long-term investing, the conditions for this, and I've been saying this in a lot of videos, is that your money should always be in excess. It doesn't matter if you're trading, it doesn't matter if you're investing. If you're putting in money that you need, then that's wrong. If you're putting in money that you're gonna touch soon, then that's also wrong. It has to be money that at the end of the day, and I've said this in so many videos, the reason why I can sleep well at night no matter what happens to the market is the money that's there, tanggap ko even if it goes to zero. I know it won't go to zero, but tanggap ko even if it goes to zero, I'm okay with it. No matter if it's 1 peso, 1 million, 1 billion, I will only invest an amount of money that I'm comfortable with, that should be an excess, that regardless of what happens, regardless if the market is down, I still have cash that can protect me. I still have cash that can allow me to be able to eat properly, buy the stuff that I want, drink the coffee that I want, help me live a normal life. Then, aside from that, it's basically this. 10-year time horizon, excess money, and your cash flow should not be disrupted. Meaning, if you have a business, you have employment, that should not be threatened. Money should still be coming in. So, if you think your business is being threatened, meaning there's a chance that sales will be lower, impacting your cash flow or your employment, pwede ka mawalan ng trabaho, or your commission based that nothing is coming in also, then it's highly recommended that you stick to your guns. You need to be liquid as of this point in time. So you don't have to take advantage of every opportunity that's there. You don't have to take advantage of every opportunity to make money. You have to consider your liquidity first. So if there's so much opportunity, there's so much cheap stocks, and people are saying this is one of the best times to invest, guess what? Crashes like this don't happen often, but uh, you have to focus first on your liquidity. That if your cash flow is out, then even if there's an opportunity, don't invest. So now, if you are a long-term investor, when is the best time to come in? Number one, it's not part of what I'm flashing, but when there are crashes, when you see markets drop this much, when you see it go down more than 50%, please remember, as of this video, the highest that we've ever been was at 9,000 January 2018. The lowest that we've ever been intraday was 4,000 March 2020. Then it hit 4,500. So if you look at that, it's still roughly more than 50%. When you see things like that, when there's a lot of uncertainty, when there's a lot of people that are scared, when there's a lot of people that are panicking, but because your timeline is very, very long, but your timeline is uh but your timeline is longer to recoup. No, so please remember that one of the reasons why the markets are dropping, it's not because companies mismanage their businesses. It's not because there's something wrong fundamentally on their business per se. This is a black swan event. This is something that no one could have ever predicted to actually happen. No one could have seen this, no, to no one at the end of 2019 would ever think that a virus would happen, and because of this virus, people would stop spending, people would stop traveling, people would stop going to events, that literally there would be no events, that basically pollution in the whole world would drop because no one's actually going out, that gas prices would massively go down, that there would be a surplus in inventory because no one's using gas. No one could have predicted that. But guess what? When everything is said and done, when everything gets better, when this pandemic ends, when a cure is found, a vaccine is found, things will go back, the economy will reopen, and the best time to come in, if your time horizon is very, very long, your time horizon is super long, and all of the conditions that I've mentioned above are have been met, was when the crash happened, when the market is down, when it's massive, when there's a lot of fear. But also, these are the conditions that at least you should learn. And it's very, very important that if you're a long term investor, you know the fundamentals of the company that you're investing in. You know at least the macro, you know what's happening in the industry and the sector, and you know the company, the revenue model, the debt that they have, the cash that they have, is it impacted, is it actually hit? So number one, you really need to know that in spite of this coronavirus, the company that you're looking at, is it still growing? That after all of this is said and done, will the company still grow? That by 2022, 2023, 2024, 2025, 2026, 2027, from 2020, when this gets treated, will the company go back to its long-term trajectory of earnings? If the answer is yes, then it must be it's a company that you can consider worth buying. If the answer is no, then even though it has a popular name attached to it, then maybe you should not be buying it as well. The name of the game is you knowing the company, not just looking at the label, if it's considered blue chip, if it's considered a company that has a high market cap, or if it's a company that has a popular CEO. Don't just go for that. Look at the fundamentals. You need to know if the company is growing, if the earnings are growing. And I'll say this over and over, that you do not make money from what the company did in the past. You will only make money from what the company could possibly do in the future, its trajectory of growth, its trajectory of how good it is. So, one of the things that you need to write down, please write this down. If you're a long term investor, you better make sure that the company you're buying today will still grow in the future. It's not worth buying Kodak films because, as you all know, no one uses films anymore. No one uses fax machines, no one uses answering machines, no one uses pagers. So companies like that were so relevant in the 90s, today no one uses them because there's but before people stop using them, their growth also stopped. So one thing that you could look at already is the company growing, is the company doing better? Because if they're growing, guess what, 2, 3, 4, 5 years from now, there's an expectation that their income will still continue. But above and beyond that, it's this: you want to buy a company that's growing, but you want to buy a company that valuations wise, it's still cheap. It doesn't make sense buying something that's growing that's very, very expensive, because if you buy something that's very, very expensive, then the upside for that company won't be there anymore. Then the upside for that company won't be as good, it won't be as attractive. So if it won't be as good and it won't be as attractive, then you may not get the possible earnings that you could possibly get if you bought it lower, you bought it at a price where the valuations are showing you that it's a really, really good time to start coming in. So that's why I mentioned it from the get, that it's very, very prudent to come in when there's a lot of fear, because when there's a lot of fear, sometimes it's emotions that bring markets down, and when it's emotions that bring markets down, people sell not out of fundamentals, but they sell because they want to be liquid, they sell because they need the cash, they sell out of emotions, and because of that they bring stocks to ridiculously cheap prices. So those are some of the things that you need to consider if you want to buy a company, and you want to start coming into them. So the best time to come in, again, when there's a crash, when there's a recession, when people are scared, but also you need to look at the fundamentals of the company, that the company needs to be growing and valuations are cheap. We're currently at the 18-minute mark of this video. I hope that you guys are learning. I hope that you guys are getting something from this. If you are, comment I'm learning. And if you're also learning and if you're getting value from this, I appreciate it if you press the like button, you can press the thumbs up button, because it really helps the YouTube algorithm show this to more Filipinos. And the reason why I keep making a lot of videos, this is just part of the other videos that I'm doing for the day that's posted also today with an interval of 1 hour. But the reason why I'm doing videos like this is I just really want to change the narrative, that it's time for Filipinos to prioritize learning. It's time for Filipinos to learn the right way, to learn something that will also uplift them, that will bring them to a much, much higher place. So I answered the question, when is the best time to invest if you're a long-term investor? And I hope you wrote those parameters down. Now the question is, what if you've already bought? What if you own stocks? Or what if when should you actually sell? So for me, the answer to that is basically this: when is the best time for you to sell the stocks that you own? So if you're looking at it from a long-term investor, it does not also mean, no, that tatapusin mo yung 10 years. That's not possible. That's not entirely true that you sell at 10 years. That's your time frame lang, kasi you can always transfer to another stock in between that 10-year period also. It doesn't mean you're a trader. Please remember, the main context of traders is basically they trade, they sell based on the volatility or they sell based on the trend. They sell when their sell parameters from either the volatility or the trend have been already hit. But if you're an investor, the best time to sell is just basically this. When the company that you bought has stopped growing. Meaning you see it growing through the years, and suddenly for 1 2 years it suddenly either dropped massively, their income dropped massively, or you suddenly see it start to mature. They're still earning, they're still getting a lot of money, they have a lot of cash, but they stopped growing already. So when you see that, that could be a trigger for you to sell. And that could happen on the fifth year, that could happen on the seventh year, that could happen on the eighth year. You don't have to sell just because it's on the by you waiting on the 10th year. When I say 10 years, that's your entire duration in the market at the bare minimum. But when sell signals for that company start to come out, you could already start to sell already based on that. For those who want to know what parameters are that are that I have a couple of videos here in this channel that focuses on fundamental analysis. You could research on that on this channel, or you could read my book, Winning Strategies for Investing. The link is in the description. You can order that via Shopee. Or when we have Stock Smart sessions again, of course, we're going to tackle that on fundamental analysis. Second reason for you to sell, it's just the opposite of the parameters that I set a while ago. If kanina I mentioned the company is growing, you sell when the company has stopped growing. If I mentioned kanina also that you buy when the valuations are cheap, one of the reasons for you to sell also is the valuations are already expensive. So I want to say this also, that if you hit the stock and then it becomes too expensive already, even if your gain is only X amount, you also have to sell and you also have to get out of that position. Or if you bought a stock and then you are at a loss and then suddenly the company has stopped growing, the best thing for you to do also is to get out of that position. Now, a lot of people are asking, if you are an investor, should you sell at a loss? Because there's a lot of people saying that if you are an investor and the stock drops, just hold on to it kasi babalik din yan. The answer to that is twofold. Number one, you buy a stock, okay, and it has dropped. If it has dropped and the fundamentals have not changed, then by all means, do not sell. If you bought a stock, it drops, and then you are at a loss, but the fundamentals of the company has massively changed, then you sell. By the time I'm making this video, you should have known by now also that Warren Buffett sold his positions in all of the four major airlines in the US, meaning he took a loss. When I say loss, it's not millions of pesos, it's not billions of pesos, it's billions of dollars. He cut loss on billions of dollars, and it's a large amount of money. People will say he can absorb it, he's Warren Buffett, but please remember, he's not cutting loss because he has a lot of money. He's cutting loss because he already saw that it's not worth holding on to a company whose fundamentals have changed. And please remember, if there's one industry that gets hit the most, that gets battered the most, that will get changed the most because of what we're seeing here, it's the airline industry. And it's because of the airline industry getting hit, battered, it may take a long time for people or for that industry to recover also, especially when you see it, when even if prices are lower but people don't travel, then the fixed cost of the airlines become massive. And please remember that as airplanes are meant to be on the air, the longer they are on the ground, it becomes worse for the airplane, because that's where its materials rot, and that's where there's a lot of overhead costs, particularly for those airline companies as well. So those are the things you need to consider. You sell at a loss if the fundamentals have changed, if the company is not so good anymore, even if the stock price is down. Now, to piggyback on that and to double down on that, what if the stock price has dropped? If you are a long-term investor and the company's fundamentals have not changed, we mentioned it already that you hold on to your position. But here's the thing, if you have cash, it would be a good way for you to continue to add to your position. I repeat, if the stock that's fundamentally sound, that's still growing, that's undervalued, and its fundamentals have not changed even in the crisis, and you're holding on to it and you have cash, It's an opportunity for you to add some more. It's an opportunity for you to position lower. And you're not doing that just for the sake of averaging down. You're not doing that just for the sake of lowering your average. You're doing that because you know valuations wise a company's cheap. You're doing that because you know the company that you're buying is still good and growing and it's still profitable and the fundamentals have not changed. If you cannot answer that question and you're just buying it again, adding again uh, because you think it's it's what's proper to do, but you cannot answer the question. You cannot answer the question on valuations. You cannot answer the questions on the macroeconomy. You cannot answer the questions on fundamentals. Then you should not be adding. The only time you add more, the only time you start doing an action is when you're fully convinced of what you're supposed to do. If you're not fully convinced of what you're supposed to do, no matter what you see, you don't do anything. You base your actions, you base your decisions based on numbers, based on what you know, based on what you studied. Because in the absence of all of that, emotion will just kick in. And emotion is one of the biggest things that will tell you or will push you to lose more money as well. We are at the 25-minute mark. Are you learning? I still have a couple of slides. Comment below if you're learning. Thumbs up, please, if it's something that's helping you. If you know more people will benefit from this, appreciate it if you can share. So, why do traders say, though, that avoid the stocks that are cheap, do not catch a falling knife? Please remember, it's very very true that if a stock is falling and you're a trader, do not catch it while it's falling. Do not catch it while it's dropping. If you are a trader and then you own a stock and it starts to break down, by all means you have to sell, you have to cut, because all of those conditions are for trading. What we're talking about in this video is primarily focused on investing. It's for investing. It's for people with all of the conditions that I've set. That's why the mentality for trading and the mentality for investing are totally different. These are the set of rules for trading. These are the set of rules for investing. If you mix them together, you will lose. If you flip flop in the middle of the game, you will lose. If you're a trader, then you become an investor, you will also lose. You follow your plan. If you need to sell, you sell. If you need to buy, you buy. If you need to hold, you hold. If you need to avoid, you avoid. You follow your plan to the very letter, because it's your plan, it's your strategy, it's your conviction that's gonna see you through. That it's gonna help you make money when everyone else is losing. It's gonna help you have the conviction to buy when everyone else does not want to buy. And that's where the Warren Buffetts of this world are formed, when they do something that's contrary to what majority of the people are doing. And I'll say this again: if you do what everyone else is doing, then you will end up like everyone else, and everyone else is not as rich as Warren Buffett. If you want to make it, you have to do something that's opposite. You have to do something that's contrary. You have to stick to your guns, because your strategy will work for you. It won't work for everyone else. So there. Did you guys learn a lot? Comment below what's the best thing that you've learned on this. I want to hear about your thoughts, your ideas, if this is something that's helping you. If you want more videos similar to this, more learning activities similar to this, comment I want more. And if again, if this benefited you, appreciate it if you could press a thumbs up and the like button, because it helps the YouTube algorithm show this to more people. If you want to learn more and more of this via books, I have 5 books. They're all available via Shopee. The links on how you can order are in the description. And if you are in an area where Shopee does not deliver into, there's another link beside it where they can where the online shop can send it to you to other areas that Shopee does not cover. Or if you are an international subscriber and want the book to be sent to your area in the world. So there, super appreciated again if you can subscribe. For those who want to learn via online courses, I have a Tagalog online course with Chinkitan. It's called Stock Market for Everyone. The link on how you can enroll to that is in the description. Then another one is Make Money, Grow Money. It's with Sean C. It's a online course that we did and recorded a few months ago. It's about business, entrepreneurship, and investing, and the stock market. The link to that is in the description as well. Then we also have an online course coming up in the next few days. It's via Zoom. It's interactive with Q&A with Shansi also. Link is in the description for those who want to enroll. And there, 2 channels, Marvin Germo and Marvin Germo Podcast. I hope that this is something that will give you enough insight. And please subscribe and hit the bell so you get updated every time I come up with new content about all of this. So there, I hope you guys got a lot from this. I hope you guys got a lot from our topic. And if you guys want to learn more, just keep on sending those questions, and I'm going to make more videos for all of you guys as well. And basically, that's it. This is Marvin Germo, pushing you, nudging you that you have to take this time to learn. You have to take this time to learn more about the rudiments of investing, because at the end of the day, it's your knowledge, it's your understanding that no one can take away from you, and that's what's going to help you make money in the markets. So that's it for now. Marvin Germo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, guys, and God bless you all.